నమస్కారం. డాక్టర్ బిఆర్ అంబేద్కర్ ఓపెన్ యూనివర్సిటీ విద్యార్థులకు స్వాగతం. ఈనాటి కార్యక్రమంలో ఎంబీఏ 2వ సంవత్సరం చదువుతున్న విద్యార్థుల కోసం ఫైనాన్షియల్ మేనేజ్మెంట్లోని లివరేజ్ అనాలిసిస్ అనే పాఠం ప్రసారం అవుతుంది.
Success or failure of any organization to a greater extent depends upon the effective utilization of resources. The resources such as human resources, financial resources and other natural resources which are very scarce in nature and not freely available in the nature. Hence, while taking any decisions with regarding to the investment proposal, one has to employ financial management techniques such as capital budgeting, or leverage analysis and other techniques. After independence, huge investments were made in both central and state public enterprises as a part of the planned economy. But in the recent past, the whole public enterprises, barring a few, are undergoing phenomenal changes. The investments made in these enterprises are not optimally utilized due to various reasons which led to declining profitability, operating losses and forcible closure or disinvestment.
How is financial management an important functional area?
Well, financial management is basically concerned with certain functions, namely the allocation of scarce resources among the productive uses. Popularly we call it investment decisions. Providing finances at times of need through various sources at lower rate of interest or at cheaper rate of interest, that is financing decisions. Providing finances at times of need through various sources at reasonable or lower rate of interest and effective utilization of cash, which we popularly call it financing decisions. Maximize the market value of the firm, that is wealth maximization or dividend decision.
What factors should we keep in mind while designing the capital structure of a firm?
Capital structure is nothing but opting for mix of various components of capital. Capital can be of loan capital, ownership capital. Within ownership capital we have preference share capital and equity share capital. As you all aware that equity shareholders are the real owners of the firm. Preference shareholders by name, they have two preferential rights. Number one is taking back the capital at the time of liquidation of the company. Number two is they are entitled to get fixed rate of dividend at the end of each year. Whereas equity shareholders, they are the residual owners of the firm. When we talk about the debt capital lenders, they are not the owners, they are entitled to get only interest. When we compare these two things, the cost of debt is cheaper than cost of equity because the interest payable to the money lenders is tax exempted. So, keeping in view all these things, the objective or the goal of any financial management is to incur lower amount of cost of capital and increase the shareholders' return. For this purpose, while designing the capital structure, we have to keep in mind certain things, namely cost, risk, control, flexibility, timing, etc.
What is the need to calculate leverage?
Leverage is employing finances or an asset for which a firm has to pay fixed cost. Every firm, irrespective of its size, needs fixed capital and working capital. Whenever we employ fixed capital, we incur fixed cost. Whenever we employ working capital, the cost incurred can be said variable cost. By name, variable cost is treated as the product cost. Fixed cost is treated as a period cost. Hence, it is a fixed in nature. Whether you have production or not, we have to pay it. That is fixed cost. Leverage is a managerial decision to decide the mix of debt and equity component. Leverage can be of operating leverage and financial leverage.
What is leverage?
Usha, I thank you very much for asking this question. It's a very important part of financial analysis, and this part of financial analysis shows how performance of a corporation is affected by the financial decisions regarding debt and equity, regarding the capital mix, on the earnings per share of an enterprise, and it also shows us as to how good performance at the gross margin level, at the level of profits before interest and taxes can be converted into a negative performance if an optimal decision regarding financial mix is not taken.
Why is leverage important?
See, again, I thank you for asking this question. Often when we talk about the analysis of leverage, we talk of financial leverage, we talk of operating leverage, and then as a composite measure, we also talk of combined leverage. Now, if we do analysis in these parts, then we come to know that the overall performance of an enterprise in terms of earnings per share, in terms of growth in finances is determined not only by good policies regarding management information system, regarding vendor analysis, regarding materials acquisition, regarding supply chain management, regarding good HRD systems, but also it has a lot to do with the decisions that we have taken about the structuring of the capital mix, and also about the use of the funds that we make in relation to the outputs which are turned out by an enterprise in terms of production of goods and services. Therefore, what I would say is that analysis of leverage is very important. It shows us that, among other things, decisions regarding shaping the leverage is very significant for the continuance of an enterprise and also its competitiveness in the market.
What exactly is the operating leverage and how do we calculate it?
Operating leverage is the relationship between the sales and the fixed cost. Operating leverage helps us to understand the implications of increase or decrease in the fixed cost in relation to marginal variation in sales. Operating leverage is equivalent to contribution divided by operating profit. Degree of operating leverage is equal percentage of change in operating income divided by percentage of change in sales.
What is financial leverage and how do we calculate it?
Financial leverage may be defined as the ability of a firm to use debt capital. To optimize the return to shareholders, we have to combine the debt and equity component in such a way where the cost of capital is very nominal and the return on investment is very high. So, this is called financial leverage. Financial leverage may be defined as the ability of a firm to make use the debt capital. Financial leverage is equal operating profit, that is earnings before interest and tax divided by profit before tax. Degree of financial leverage is equal percentage of change in net income divided by percentage of change in earnings before interest and tax. We are also required to compute the combined leverage. Combined leverage can be simply computed by multiplying operating leverage into financial leverage, or contribution divided by operating profit into operating profit divided by profit before tax is equal contribution divided by profit before tax.
What is the concept of leverage? How do you differentiate between operating and financial leverage?
In the financial management, generally there is a risk concept is there. Then the risk is indirectly defined as a leverage, and the leverage tells the relative change in the profitability due to change in the fixed expenses. It may be fixed costs, variable fixed cost of operating as well as a financial cost. If it is the relationship between fixed cost and the profitability, that is considered as to be operating leverage, and the relationship between profitability and your financial expenses, that is interest, that is called as financial leverage. For any organization, whether it is a smaller organization or the bigger organization, the operating leverage and financial leverage play a dominant role in the profitability of the company. Either it may be profit after tax or it may be EB, earnings before interest and tax. There are two types of profits. One is operating profit and business net profit. The operating leverage tells the relationship or demonstrates the relationship between operating profit versus the sales. The percentage change in the sales leads to the actual change in the profitability. That relationship between the profitability versus that operating profit and sales is called as operating leverage, and the relationship between financial expenses and the profit after tax is called as a financial leverage. In general, the operating leverage tells you the operating performance of the company, that is the relationship between variable cost and the fixed cost. And for any company, if there is no fixed cost, there is no operating leverage. And operating leverage generally relates to the fixed cost component in the total cost of the production. Then the relationship between fixed cost versus total cost is called as an operating leverage. The higher operating leverage leads a higher profitability and higher responsive change in the sales and the profitability. And financial leverage talks about the relationship between earnings before interest and tax and profitability, that is a profit after tax. The higher interest rate measures higher profitability. And when there is a tax effect, and the relationship between a return on investment and the interest makes an impact on the business firm.
How do these two leverages influence the decisions of a firm?
See, for every business unit, the ultimate aim of a business is they maximize the shareholders' wealth or they maximize the profitability. This profitability is two components. One is operating expenses and the financial expenses. And within the operating expenses, the fixed expenses play a dominant role in the sales volume. The fixed expenses relationship with the total cost tells you if the higher operating expenses, higher operating profit and lower fixed expenses, it will have a lower impact on the profitability. And increase in the sales will influence only marginally in the profitability, whereas in case of higher operating leverage, a slight increase in the sales will lead to higher earnings before interest and taxes. Similarly, in the case of the financial leverage, if a high financial leverage, then that company is considered to be highly risky, and when the financial leverage depends, that is interest, the debt on the total capital structure. If the debt component is very higher, then that company is called highly financially leveraged, and that leverage tells you when the interest rate on the debt makes an impact on the profitability. There are three measures of measuring the financial leverage. One is the relationship of the debt towards the total capital employed of a company. Total capital employed of a company means that is a total debt, that is a long term and medium term, plus the net worth. And generally the short term borrowings and the temporary loans and current liabilities are excluded from the total capital employed. The relationship between the total debt, that is the long term debt of the company, versus the total capital employed of the company tells the financial leverage of the company. That is one. And second thing, the second measure of the financial leverage is to relationship between the debt versus equity. That is talking about how much is a borrowed fund, how much is a owner's fund. That tells the relationship between the debt and equity. The third measure of leverage is talking about debt service coverage ratio or we also call it interest coverage ratio. The interest coverage ratio defined like that EBIT upon interest. The EBIT stands for earnings before interest and tax. That is also called as an operating profit upon the interest. That means how many times the company could earn to pay to interest. That means interest obligation is 10 lakhs. If the company earns 100 lakhs, that means the company is having 10 times the debt service coverage ratio. Then recently that lot of companies are adopting the off-balance sheet financing, that is like leasing, that hire purchase and sinking fund fixed obligations. These are not business expenses, but these are part of a fixed obligation. If one wants to know the real financial interest coverage ratio, one has to include the lease payments, installments, as well as a sinking fund installments to be taken into account, then to find out what is the fixed charge coverage ratio.
How does operating leverage help a firm?
The operating leverage, it is a double-edged sword. The relationship between fixed expenses towards sales, that is the total cost of production. If there is high fixed expenses and higher fixed expense ratio and increase the volume of the sales, it will have a positive impact on operating profit. And your higher operating expenses takes care in the larger volume. If you talk about average fixed cost, it will be reducing as you increase the volume. Therefore, in the case of a higher operating leverage, if you increase the volume, there are the probable chances of earning higher operating profit. The reason behind this is that the fixed costs remain constant whether you produce 100 units or you produce 1000 units. When you increase the production level, then the cost of production remains constantly growing according to the variable expense and not to the extent of the fixed cost. Therefore, what will happen when you increase the sales production or the sales, the average fixed cost is reducing. The total fixed cost is remain constant, but the variable fixed cost, the average fixed cost is reducing to that extent, and that leads to increase in the bottom line. That is a contribution. That is we call it operating profit. And in the case of the lower operating cost or the no operating cost, that doesn't, the increase in volume or increase in production will not affect your profitability. Therefore, the portion of the fixed cost, when there is a higher fixed cost, the company or the firm tend to produce more and more goods and commodity to sell, and that will influence. And the relationship, how one has to make a finding out, there is a called a break-even analysis. The break-even analysis tells you where the firm earns neither profit nor incurs losses at the level at which the firm is selling or producing the commodities and the units, neither losses nor profits. That is a break-even point. When the variable cost is higher and the variable cost of production and the fixed cost of production, then the relationship one has to understand before proceeding to the increasing the size of the production and the shift, using the double shift or the third shift. Therefore, ultimately the success of the production level and the profitability level depends on the operating leverage. And this is very, very important to find out the efficiency of the factory production level and operating level. And this talks about operating profit versus the production cost, the fixed cost in terms of the labor fixed cost, material labor cost, and the sales. All fixed costs are talking about operating expenses. Therefore, the profitability, operating profit is generally influenced by the operating leverage. And higher operating leverage, higher risk, higher profitability, risk reward move together. Therefore, the companies which want to operate in a larger level, they should have a higher operating leverage.
What are the implications of financial leverage? How does it help in improving EPS or shareholders' value?
There are certain assumptions in a company. When there is an investment is required, the company or the firm has two options, either going for a debt or equity. That is based on the cost of capital, either cost of debt or cost of capital consists of two components, that is the cost of equity and the cost of debt. Then what is the cost of debt and what is the cost of equity? Those are the important key factors in determining the mix of the debt and equity. Across the world, the interest on debt is tax exempted. That means the companies pay the interest before taking into account the tax calculation. Therefore, there is an advantage across the world that the interest is having a tax shield. That means profit-making companies when they pay the interest, that is debited to the profit and loss account. To that extent, they have get the tax advantage. And apart from that, the debts have a prepayment, that's a fixed obligation, and they don't have the variable or the residual right on the profitability. And whereas the equity, they are having a residual ownership and the residual profitability, and the success or the failure of the company is taken care by the equity holders. Therefore, the debt component or the interest cost determines the size of the debt. And how does it influence the company? That is basically depends that all the companies will not benefit by borrowing as much as possible. There is three important considerations. That is, what is the cost of equity and the cost of debt. Generally, cost of debt is lower than the cost of equity, because in the cost of equity you have to serve the equity holders, and there is a dilution of EPF effect, and apart from that there is a management control threat. Therefore, management, while deciding the debt equity mix, they take into account not only the cost but also the earning capacity of the company and the future potential of the earnings and the tax rate. When the return on investment, if the company earns more than its cost of debt, then the companies tend to borrow more and more, and that means the interest rate, if the return on investment is higher than the cost of debt, then that is having a favorable impact on the profitability and the earning, that is a PAT. And the earning in PAT, the favorable effect on PAT leads to higher EPS to the higher value creation for the shareholders. When the return on investment and the cost of debt are equal, after taking into a tax account, it will not affect either business in a positive way or a negative way, because the cost of debt as well as the return on investment, that is income expense are equal. Therefore, it has a negative, no impact on the business or the company. But in the third scenario, where the return on investment is less than the cost of debt, that means we borrow at higher cost than we earn. At that time, it has a negative impact. Therefore, cost of the leverage, the financial leverage, has an implication, the positive as well as negative on the company. When the company is earning more than its cost of capital, then it is a positive impact on that, and that positive impact has increase in EPS. Increase in EPS is nothing but increasing the value of the shareholders. Increase in EPS leads to higher DPS, dividend per share. Higher dividend per share creates a market impact and sentiment, and it will also reflect in the market price of the company. Therefore, generally the growing companies, high growth companies, generally tend to go for the leverage, the financial leverage, and these three aspects one has to take into account. Where does one get the benefit of using a leverage? The first is the cost of debt. The second factor is the tax rate. If there is a zero tax, if there is no tax in economy, then debt doesn't help as it helps in the tax mechanism, because the tax, what you benefit, what you avoid by reducing the less tax, by reducing the tax liability to the government, that will be benefited by the company. And if you look at in a macro level, the company is benefited, but the economy is not benefited by using a debt, because the loss to the income tax department is the profit to the company. Therefore, that is a tax impact. And second, the rate of debt, because generally the debt is less risky than cost of equity. Why? Across the world in the finance theory they talk about cost of debt is less than the cost of equity. Cost of debt is having a less risk. Therefore, the risk means the variability of the return. The fixed charge and obligation, therefore, the debenture holders or the fixed bond holders expect less return than they expect from the investment in the equity shares. Therefore, basically the equity is having higher risk than the debt. Therefore, the debt generally expects lower return than the equity. That one has to take that risk taking. Some of the companies, they don't tend to borrow because there is a liquidation expenses. In general, in a nutshell, we can consider when the cost of debt is lower than the equity, it is better to borrow. When the companies are earning profits and they have the tax liability, at that time also it is advantageous for the company to borrow more than the equity.
What is financial risk? How does it differ from business risk?
You see, for any business, when there are various kinds of risks, first of all, let us understand what is a risk. Risk is nothing but in the business term. The risk in common parlance, we talk about some untoward incident, negative incident. But in the business, also there are uncertainty, and that in business we call risk is the variability. That means the change in the expected return and the actual return. Suppose you expect 100% return and you may get 80%, you may get 120%. That is called as risk. That is a variability in the expected returns. And in a business firm, you have two risks. One is business risk, and that business risk consists of operating risk, financial risk, credit risk. But in financial management, basically there are two kinds of risks. One is a business risk, another is a finance risk. The business risk can be classified into two kinds of risks. One is a systematic risk and unsystematic risk. The risk which is related to overall economy or macroeconomic factors, it is not only applicable to one firm or the X firm, it is applicable to all the firms. That is called a systematic risk. That is like economic risk, the inflation risk, the war, international threat. All these factors lead that this will applicable to all the companies, the depression, the recession, all those factors. There is another kind of risk is particular. This is particular to a specific company, that is called as unsystematic risk. Suppose you are going for an ice cream factory, ice cream business, and if there is a year there is a lot of rainy and a lot of very cold weather, then you don't have much of business in that. Then if you have a coffee business, you have a different risk. Then you go for textiles and the software. Therefore, this is called as a specific related risk, and this risk can be diversified, and for that you get a premium. The total return for any investment consists of, one is the risk-free rate, the risk-free return. That means without taking any risk, by investing in a government bonds or government treasury bills or State Bank of India fixed deposit, you get risk-free rate of return. That means you have a guarantee from the sovereignty, therefore that is risk-free rate of return. The other return is the risk premium. You are taking from zero risk to a certain extent of risk, that is called as a return for your premium, that is called as a risk premium rate. In the business firm, we have two kinds of, by investing without any risky investments or the instruments, we get risk-free rate of return. By investing, you have additional premium. But how does it differentiate the business risk? Business risk total consists of the systematic and unsystematic risk, and financial risk is risk related to the liability sides of your company. That means the risk of investment in bonds or risk investment in the warrants or fixed obligations, that is called as a financial risk. The change in interest rates may lead. Today you have invested at 12%. In a bank or in IDBI or ICICI, the interest may tomorrow it may go up. It may from 12% to 16% or 14%. Therefore, you are in a negative risk, that you have expected that interest rates are 12, therefore you have invested at 12% and there is a higher return. Then lot of institutions had borrowed at 16% and 18% during 95-96, and they had a lot of risk. Today they are lending at 12%, whereas they have borrowed at 16%. That is called as finance risk. That is a credit interest rate risk. And you have foreign exchange risk. Companies which are borrowing internationally or investing in internationally, they have additional risk of foreign exchange risk, or that is also part of your financial risk. And the total components, the one is the principal risk, that credit risk, various components lead to financing risk, and the finance risk is also part of your business risk.
ఈ కార్యక్రమాలకు సంబంధించిన సూచనలను సలహాలను ఆహ్వానిస్తున్నాం. చిరునామా డైరెక్టర్ ఆడియో విజువల్ ప్రొడక్షన్ అండ్ రీసెర్చ్ సెంటర్ డాక్టర్ బిఆర్ అంబేద్కర్ ఓపెన్ యూనివర్సిటీ ప్రొఫెసర్ జి రామరెడ్డి మార్గ్ రోడ్ నంబర్ 46 జూబ్లీ హిల్స్ హైదరాబాద్ 5,33,000.
In our earlier lesson, we have covered certain theoretical facets of leverage analysis, that is as a part 1. In this lesson, today we are going to certain practical things. We are going to work out certain practical problems in this lesson. Now, as we all know that every business firm needs capital. Capital can be of ownership capital and a loan capital. Now, as a prudent financial manager, one has to be very careful while employing the different components of capital, that normally we refer it as a capital structure. So, capital structure should be in such a way that where the cost of capital is very nominal and the rate of return is very high. Keeping in view this, we have to employ the mix, that is optimal mix of debt and ownership capital. Now, to start any business, we can either employ solely ownership capital or solely loan capital, but as a manager we have to maximize the profitability, hence we have to go for a mix which gives maximum return to the firm. In this connection, as you all know, ownership capital can be of equity share capital, preference share capital, and loan capital can be of debentures or long term loans, etc. Now, as you all aware that the preference shareholders, by name preference shareholders have certain preferential rights. Number 1 is to get a fixed rate of dividend at the end of each year and getting back the capital invested when the company goes into liquidation. These two are preferential rights of preference shareholders, whereas equity shareholders, they are the real owners of the firm, whether the firm incurs profit or incurs loss, it is they have to bear. When we talk about the debentures or debt capital, they are entitled for fixed rate of interest. Interest which is allowed is tax free. So, it is treated as normal expenditure and will be deducted from the gross income as it is. So, whatever we pay towards interest is tax exempted. Now, for designing the capital structure, it helps a lot to maximize the profit, because the dividend is payable after the dividend whatever we pay to the shareholders is of tax component. Hence, leverage analysis is basically concerned with two things. Number 1 is employing fixed capital. As you all aware that every business firm requires fixed capital and working capital. Fixed capital, once invested in any fixed assets, it cannot be taken back unless you incur heavy losses. So, while employing the fixed capital, that is while employing the fixed cost, one has to be very careful. Similarly, while employing the debt capital also, a financial manager has to take utmost care. The dividend payable to the preference shareholders and the interest payable to the debtors is fixed in nature. Leverage analysis helps us in employing capital fixed assets as well as employing debt capital, because these two components are very vital for any management. Leverage analysis is basically concerned with the mix of debt and equity components. As explained earlier, the debt capital is cheaper than equity capital, hence one is prompted to go for debt capital. Now, as I have already explained, the sources of finance can be either equity share capital, preference share capital, debenture capital, or it can be a mix of all these three components. Basically, we can say that debt capital and ownership capital. Within ownership capital, we have preference shareholders and equity shareholders. These two are the dividend whatever is payable to the equity shareholders or preference shareholders will be only after tax. Hence, it does not affect the profitability, that is profit before tax. So, only thing is we have to keep in mind, or we have to think about the debt capital. As I have already explained, the cost of debt is cheaper than the cost of equity, because it is tax exempted. Hence, cost of debt is cheaper than the cost of equity. So, while employing the debt capital or equity capital, one has to take utmost care. Now, let us assume that a firm requires 100 lakhs of capital. So, as I told you, the capital can be of either debt capital or equity capital, that is ownership capital. Now, let us say a firm requires 100 lakhs capital. So, this 100 capital can be either employed through solely debt or solely equity, that is ownership capital, or it can be a mix of both. Now, let us take let us take a hypothetical case where the debt is 0 and equity is 100, debt is 10, equity is 90, debt is 30, equity is 70, debt is 50, equity is 50, where the debt is 80 and equity is 20, debt is 100 and equity is 0. Now, when you observe, when you try to calculate the debt asset ratio or debt equity ratio, debt asset ratio is nothing but the total debt divided by the assets. Asset is nothing but the total capital employed. Similarly, debt equity ratio is equal to debt divided by the equity share capital. Look at the table which is given, where the debt component is given at 0 lakhs, 10 lakhs, 20 lakhs, 30 lakhs, 50 lakhs, 80 lakhs and 100 lakhs. Similarly, equity is 100 lakhs, 90, 80, 70, 50, 20, 0. When you compute the debt asset ratio, it is 0, 10, 20, 30, 50, 80, 100. When you compute the debt equity ratio, it shows that it is 0, 11.1%, 25%, 43%, 100%, 400% and infinity. It gives us very clearly that the debt, as the debt increases, the percentage also increases. Now, there are several methods for computing debt and asset ratio and debt equity ratio. One of the methods could be debt asset ratio is equal debt by equity ratio divided by 1 plus debt equity ratio. Similarly, when you would like to compute the debt equity ratio, that is D by E ratio is equal to debt by asset ratio divided by 1 minus debt by asset ratio. Let us take a manufacturing firm and compute the operating and financial leverages and how it is going to help the management in making certain managerial decisions. Now, look at the problem which is given. In this example, the installed capacity of the firm is 600 units, operating capacity of the firm is 400 units, the selling price per unit is rupees 10, sales 400 units, variable cost rupees 6 per unit. Now, basically operating leverage and financial leverage, when we compute the operating leverage, the fixed cost will go on changing, in the sense we compute the operating leverage at different levels of fixed cost. So, we are trying to take different levels of fixed cost and compute the operating leverages. For computing the financial leverage, what we do is the total capital required for a firm will be mixed in at different proportions and will calculate the financial leverages. Now, for this example, let us take the fixed cost. For situation A, it is 400, for situation B, it is 1000, for situation C, it is 1200. Now, here what we are trying to do is we are trying to increase the fixed cost at 3 different levels, that is 400, 1000 and 1200. So, situation A, situation B and situation C, under these situations how the operating leverage is going to affect, let us compute it. Now, as it is, let us take situation A, B, C. Sales remains constant, that is 4000, 4000, 4000 for all the situations. Variable cost at the rate of 6 per unit, it is 2400, 2400 and 2400. Now, contribution, that is contribution is equal selling price minus variable cost, which is popularly known as contribution, which is 1600 for situation A, situation B 16 and situation C also it is 1600. Fixed cost, as we are trying to change the fixed cost to different levels and trying to compute the operating leverage. Hence, fixed cost for situation A 400, B 1000, C 1200. Now, operating profit, that is contribution minus fixed cost will be equivalent to operating profit, which is also known as earnings before interest and tax, which is coming to 1200, 600, 400 respectively for situation A, B, C. Now, operating leverage is equal contribution divided by the operating profit, that is earnings before interest and tax. For situation A, it is coming to 1.33, for situation B, it is coming to 2.66, and situation C, it is 4. Now, as I have already explained, operating leverage is a relationship between the sales and fixed cost. Now, in this example, let us take that if 10% change in volume will lead to 13.3% change in operating profit. Similarly, if you take situation C, 10% change in sales will lead to 40% change in operating profit. Similarly, let us try to calculate the financial leverages. Operating leverage for situation A, B, C is 1.33, 2.66 and 4 respectively for situations A, B and C. Now, operating leverage reveals that a 10% change in sales will lead to 13.3% in for situation A. Similarly, a 10% change in sales situation B leads to 26.6% increase in operating profit, and for situation C, 10% change in sales will lead to 40% increase in operating profit, that is before interest, that is profit before interest. Now, it is very clear from this table that as the fixed cost increases, so the operating leverage is also increases, which shows very high risk. It is very risk. When the operating leverage increases, the earnings per share also will increase and the profitability will also increase, but as the profit goes up or as the operating leverage goes up, it is very risky. A prudent financial manager has to be exercise at most care here, because whenever there is a positive sign, it is advisable, but in case of any negative things, the firm has to suffer a lot. Hence, keeping in view this, one has to be very careful in employing the fixed cost, that is operating leverage. Now, let us compute the financial leverages for all these situations, that is A, B, C under different components of capital, that is different mixes of capital. Now, as it is, let us assume that the capital required for this business is 4,000. This 4,000 can be either mobilized through ownership capital or loan capital, or we can go for the mix of these two. Even within the mix, we can have at different levels. For the purpose of computing financial leverages, let us have different plans. Plan X, where we will be taking debt and ownership capital equally, that is 1:1. Under plan Y, we will be taking 3:1. So, you will be employing more debt capital and lower and less amount of equity share capital. Plan Z, where we will be employing more amount of equity capital, that is ownership capital, and lesser amount of debt capital. So, the ratios for X is 1:1, for Y plan 3:1, for Z plan it is 1:3. Now, these different plans can be applied to all the situations, that is situation A, situation B, situation C, and we will see the results, how it is going to influence on the profitability. When we talk about the financial leverage is nothing but the relationship between the operating profit and profit before tax, that is operating financial leverage is equal to earnings before interest and tax, that is operating profit divided by the profit before tax. So, it establishes a kind of relationship between the operating profit and the profit before tax. Let us take out the situation A under different plans, that is X, Y, Z. Under situation A, the capital, now let us assume that the capital required will be equivalent to rupees 4,000, that is total capital will be 4,000. This 4,000 can be taken up at different mixes of debt and equity capital. Now, plan X 1:1, that is 2,000 and 2,000, that is 4,000. For plan Y 3,000 debt capital and 1,000 equity capital, 4,000 rupees total capital. For plan Z 1000 will be debt capital and 3000 will be ownership capital. So, the total capital required is 4000 in all the different plans. Now, operating profit for situation A is rupees 1200, it is uniform to all the plans, that is X, Y and Z. Only difference here could be the rate of interest will change, because we are employing different amounts of debt capital under plan X, Y, Z. The interest rate applicable here is 10%. So, if you take the plan X, the interest payable is rupees 200 only, 200 debt capital at the rate of 10%, that is 200 rupees. Similarly, case Y, we are employing more amount of debt capital, that is 3000 rupees debt capital at the rate of 10%. So, interest is 300. Similarly, for plan Z it is 100 rupees. Operating profit minus interest will be equivalent to the profit before tax, popularly known as PBT. So, which is coming to 1000 for plan X, 900 for plan Y, 1100 for plan Z. Now, it is very easy to compute the financial leverage, that is operating profit divided by the profit before tax, which comes to 1.20 for plan X. Financial leverage, it is very easy to compute the financial leverage, which comes to 1.2, 1.33, 1.09 for plans X, Y and Z. Similarly, let us take out the situation B and work out at under different plans, that is X, Y, Z. For situation B, the operating profit is rupees 600, capital required could be same, that is 4000, but different proportion, as we have already seen in situation A, that is 2000 debt capital and equity capital 2000, for plan Y 3000 debt capital and 1000 equity capital, 1000 debt capital and 3000 equity capital for plan Z. The operating profit for situation B is 600, which will be uniform or common to all the plans, 600, 600, 600. The interest which is going to be changed, which is going to be charged here is rupees 200, 300, 100. Now, profit before tax, which comes to 400, 300, 500. Financial leverage could be 1.5 to 1.2, this is in case of situation B. Similarly, let us work out for situation C. The capital, as it is, the capital required is 4000 rupees, that can be financed in different proportions of debt and equity, as we have seen under different plans, that is X, Y, Z. Now, the operating profit for plan C is 400 rupees, which remains constant, only the interest varies. Now, for plan X, the interest could be 200 rupees, for plan Y the interest could be 300 rupees, for plan Z the interest could be 100. Now, the profit before tax will be 200 for situation for plan X, for plan Y it is 100, for plan Z it is 300 rupees. Now, financial leverage, as it is, you know how to compute it. The financial leverage will be 2, 4, 1.33. Now, it is very clear from this problem that a marginal increase of 10% in operating profit will lead to 20%, that is double in case of plan Y. In case of plan Y, a minor change, a insignificant change of 10% will lead to 40% change in the profit before tax. Similarly, 10%, that is a marginal difference, a marginal increase in sales of Y plan will lead to 40% increase in the profit before tax. These are all different financial leverages for situation A, B, C under plans of X, Y and Z. As we all know, we can also compute the combined leverage. Combined leverage is nothing but the operating leverage multiplied by the financial leverage. From the above table, let us try to compute the combined leverage. Let us take situation C and plan Y. Combined leverage is nothing but when you multiply operating leverage in Combined leverage is nothing but operating leverage into financial leverage. In the above example, for situation C, operating leverage is 4. Similarly, financial leverage for plan Y, it is 4. 4 into 4 will give you 16, that is combined leverage. Now, under this, what happens is, we have sales of rupees 4,000 rupees, a marginal increase in sales or marginal decrease in sales will have lot of impact on the profitability of the firm. Now, let us take the sales as it is, we have worked out for 4,000 rupees, a 10% marginal increase of 10% will be 4,400 and 10% decrease, that it will be 3,600. Sales minus variable cost at the rate the variable cost will be at the rate of rupees 6 per unit, which comes to 2,400 and 2,640 for 10% increase and 2,160 for 10% decrease. Now, contribution will be 1,600 and 1,760 and 1,440. Contribution minus fixed cost is 1,200, which remains constant for all these things. Now, fixed cost is 1,200, 1,200, 1,200. Now, the operating profit will be rupees 400, 560, 240. When we deduct the interest chargeable on debt capital, that is rupees 300, deduct the interest which is chargeable to the debt is rupees 300, 300 and 300. Now, the profit before tax is 100 in normal case, 260, that is plus 260 for 10% increase, for 10% decrease it is minus 60. Leverage analysis plays vital role in financial management. As a prudent financial manager, one has to be very careful while employing fixed assets and employing debt capital, because the fixed assets will lead to operating leverage and debt capital leads to financial leverage. These two will have higher impact on the profitability of a firm. As we have seen in the above example, operating leverage was too small and it was too high at different stages. It is very clear, if the operating leverage is low, it is not that risky. When the operating leverage is very high, it is very risky. As the risk increases, the profitability also increases, but it may have adverse impact in case of negative effects in the market. Similarly, financial leverage, as the debt capital increases, so the financial leverage also increases. As the financial leverage increases, so the earnings per share also will increase. Now, it is very clear, if the operating leverage increases, it is very high risky. See, though it is increasing the profitability, it is highly risk one. Similarly, financial leverage also, as it increases, the financial leverage increases. As the financial leverage increases, the profitability will also increase. Now, when we employ debt capital, that could be taken before the tax. So, when you would like to multiply the earnings per share, what you can do is, you can go for the optimal mix of preference and equity share capital, because these two are after tax. Now, if you go for preference share capital, naturally the profitability, that is earnings per share, will increase. Leverage analysis helps a financial manager to take decisions regarding the employment of fixed capital as well as the debt capital. As you have noticed that operating leverage was too small or too high at different situations under different plans, the financial leverage was very nominal and it was very high. Now, it is very clear that if the operating leverage is high, financial leverage is high, it implies that it is very risky. A manager has to be very careful. If as long as the firm earns profit, it is okay, but in case of incurring losses, it will have adverse effects. Hence, one has to be very careful in having higher operating leverage and higher financial leverage. Similarly, higher operating leverage and lower financial leverage. To the extent possible, one has to reduce the fixed cost. to the minimum, because fixed cost is fixed in nature, it cannot be reduced. So, to the extent possible, one has to see that it must be within the reach, that is controllable. Now, other situation could be lower operating leverage and higher financial leverage. It is ideal situation to any business firm. To the extent possible, one has to employ lower operating leverage and higher financial leverage. The financial leverage will help to increase the earnings per share and profitability of the firm. Lower operating leverage and lower financial leverage implies that it is most cautious state of affairs of a financial manager. So, if these two are low, naturally one will be in a very safer way.
ఈ కార్యక్రమాలకు సంబంధించిన సూచనలను సలహాలను ఆహ్వానిస్తున్నాం. చిరునామా డైరెక్టర్ ఆడియో విజువల్ ప్రొడక్షన్ అండ్ రీసెర్చ్ సెంటర్ డాక్టర్ బిఆర్ అంబేద్కర్ ఓపెన్ యూనివర్సిటీ ప్రొఫెసర్ జి రామరెడ్డి మార్గ్ రోడ్ నంబర్ 46 జూబ్లీ హిల్స్ హైదరాబాద్ 5,33,000.